Is the economy going to fail in 2025? By now, I think you all know that I'm a Trump supporter, but Trump isn't going to be able to stop what's about to happen. You see, there are things that are happening right now in the markets and in the economy that have not happened since the Great Depression. That's what we're going to cover today. But before we get into this, I want to talk to you about a couple things that are vitally important. These are the signs. First and foremost, you've got unprecedented debt, and the dam is about to break. You are starting to see defaults creep up, and delinquencies are off the charts. We are starting to see it all unravel. Not only that, mortgage rates are inching closer to 7%. And I know if you look today, it doesn't matter, but the Dow Jones lost 1,100 points and had its longest losing streak since 1974. To make it even worse, inflation has been creeping up, not down. I know the news is saying that inflation is going down, but that isn't the fact. The fact is inflation is creeping up and consumer prices are going up as well. But this is the real one. Layoffs are coming in 2025. Unemployment benefits seem to be holding steady, but continuing claims are at 3-year highs. What is all this saying? Well, it's saying we're probably going to lose the markets this year. My name's Chris Naugle, and this is What Now? What's next for 2025? So I often talk about the winter season, and as you can see, it's winter here. Matter of fact, it is a deep freeze here in Buffalo, New York. So I came prepared. But not only am I prepared for the weather, I'm prepared for the winter season to hit the economy and people's pocketbooks. That's what we're gonna go over today. We're gonna go over some things that have not happened since the Great Depression. So let's start with this. What are the indicators of a weakening economy? Well, I'm going to give them to you right here and right now. Number one, a declining gross domestic product. That would be the first thing to watch for. High unemployment rates. Not happening yet, but coming to a theater near you. Falling consumer confidence. Yes, we are seeing a decline in consumer confidence. Decreasing retail sales. Well, if you look at Christmas time, all the sales were way up, says MasterCard, which means sales are up, but debt is up. And then rising inflation. These are all indicators of a weakening economy. But I want to put a pin in that, and I want to move on to something that I find even more fascinating, or for some of you, frightening. So what I want to talk about is the S&P 500. And I want to talk about how it's performed. Now, if any of you have money in the S&P or you've been paying attention to the gurus on social media, everything's great. I mean, double-digit returns from all of the indexes in 2024. But what you're failing to see is something that has not happened since the Great Depression. Matter of fact, it happened before the Great Depression. It happened before every recessionary period, and we're going to cover that. But I'm talking about the concentration of the stocks within the S&P 500. Now, first, I want to tell you that the S&P 500, and you already know this, is the 500 largest stocks. That's what it's made up on. Now, how much emphasis should we put on all 500 stocks? Or should we really just focus on the ones that are returning over 60% of the gains in the S&P 500? And that would boil it down to about 8 companies. 8 individual stocks. Think about that. 500 consolidated down to 8. So let me explain that. This can be a bit complicated, but the concentration of the companies within the S&P 500 means that as we look at all 500 stocks in the S&P 500, the performance of the S&P can be concentrated down to 10 stocks, specifically really 8, which we'll call out in a little bit. And when this happens, all the money that's plowing into the markets is plowing into the winners. Just chasing the winners is what we're doing. Buying high is what we're doing. We are literally focusing all the money on these 10 stocks. But here's the problem. And this is what has happened in history. That's what's so fascinating. This isn't just my observation of this. This has happened every single time the market and the indexes have concentrated down to just a couple stocks. Because think about it this way. If everybody's investing, they want to invest in the winners. You want to invest in the best of the best, right? So putting all your money in, but then what happens when the music stops? Well, all those buyers now become sellers. And because they all bought this concentration of 10 stocks, because those were the winners, now what they're doing is concentrating on selling 10 stocks, which drives the indexes down, which is like a domino effect, and it just goes faster and faster. That makes sense, right? Well, let's go a little deeper into this because I've got a lot of data that I want you to see on this. Now, let's look back a little bit and we'll go back to October of 2022. And here's what the S&P 500 looks like. 10 stocks account for 59% of their performance, while the next 10 stocks account for 11%. And the top 20 stocks within all 500 of the S&P 500 made up 70%. 70%. Are you seeing the issue here? We're dealing with a market that looks a lot like it did during the Great Depression. Everybody was buying the same thing. And also, everybody sold the same thing when things didn't look as good as they do now or back then, depending on when we're talking about it. So now what I want to do is talk about an analysis of this concentration level based on different years, and years that maybe some of you will remember. Years like 1999, 2007, right before the Great Recession, and 2021, right in the heat of the pandemic. So when we look at all those different periods, here is what happens. After those periods of time, there's a reversion. There's a market downturn, and in some cases, a really serious one. There was a drawdown in 1999 of 50%. How many of you remember the dot-com crash? I do. I almost went bankrupt. Almost had to close all my retail stores, and I ended up in Wall Street of all places because of that. When the market pulled back 50%, people weren't spending money. They weren't out buying the goods and services that I had to offer, so therefore I had to pivot. This is what happened then, and what more than likely is about to happen now. And I know, it's Inauguration Day today. I know some of you are thinking there's no way that can happen. Trump's coming into office, he's gonna fix everything. I do not disagree. He will fix everything, but it is going to take time because he's walking into a massive, massive mess. So remember, things can get fixed, but they take time. Let's keep going with these drawdowns. In 2007, the Great Recession, or right before the Great Recession, there was a drawdown of 57%. And then we move on to 2022, which came right after the Great Pandemic, is what I'm calling it now, the pandemic, and that drawdown was 27%. Nothing compared to the prior ones, but still, how many of you would want to see your portfolio drop 27%? Now, I want to give a quick shout out to Heresy Financial, Joe Brown. He's been on our show many times. He did a video covering this, which is what motivated me to go deeper into the analytics of this market concentration. So thanks, Joe, for doing that video. Now, let's get back to it. So all of this analysis is not a good sign for the markets and probably not a good sign for your 401k or your investment accounts. However, it can be an amazing opportunity for those of you that are prepared. So what do I mean by being prepared? Well, you could be prepared by having money in cash, money sitting in treasury bills, money in liquid accounts like cash value life insurance, money ready to deploy when the markets go down. Because how do you make money in the market, says Warren Buffett? You buy low and you sell high. You see, we are conditioned and trained to be emotional creatures, to just be FOMO creatures, if you will. We love to buy high because it feels so good when everything's going up. But it feels so bad and frustrating when everything goes down. And what do? Well, we bought high and we sell low, but that isn't what we're supposed to do. We're supposed to be making money. That's what Warren Buffett says. Buy low, sell high, and don't lose money. And if you reverse that and you buy high, as the majority of people are, then you more than likely will get emotional and sell low and lose money. You see, I'm not just making an assumption here. This is exactly what has happened every single time. All those concentrations that happened in those years I mentioned were followed by that exact emotional reaction. Sell, sell, sell! Because we don't know where it's gonna go. We must get out. We can't afford to lose any more. Matter of fact, you couldn't afford to lose any at all. So you took all the risk at exactly the wrong time, and now is the time to click that subscribe button. And also there's a little bell up top. That's right, smash that bell so you're notified every single time the market, every time I tell you the market's gonna go down and what to do next, something like that. Anyway, let's get back into it because this is about to get fun. There are a lot of people out there saying that they think the market's gonna have just a minor little blip, mostly because of the Trump economy and everything they're hearing. We might see a little correction of 10, maybe 15%. You see, I see it totally different. I look at the signs, I look at the debt, I look at the debt cycles, I look at all the stuff that Ray Dalio talks about, and I read too many white papers clearly. I see a pullback in the market of anywhere between 40 and 60%. You heard me right, 40 and 60%, and I think it could even be worse. Now, you can believe that it's gonna pull back 10 or 15, and that's great, but are you prepared for it to pull back more? So let's talk about getting prepared. What are some of the things that you could do? Well, I mentioned one already. You could get into a cash position. You could sell off the winners and hoard some money in cash. Right now you could have money in high yield savings accounts paying 3 to 4%. You could put money in money market accounts, which is still paying pretty good yields. Or you could have money sitting in T-bills, maybe even treasury bonds, which I know some of you might be a little bit off your rocker on the treasury bonds, the long-term ones, because they've been going down, which is exactly why you should be buying them, because the next phase, they will go up as the Fed keeps dropping rates. But you could also have a bunch of money sitting in cash value inside your specially designed whole life. I'm just giving you some pointers because then you're ready to deploy the money. And in a moment, I'm gonna tell you how you could save and spend at the same time. How you could have money sitting somewhere earning interest and growing while still investing somewhere else with the same dollars and making money twice. But I'm getting ahead of myself. Some other things that you could do, and all of you that are in the markets should talk to your advisor or just do this yourself, set up some stop losses, some aggressive stop losses. What that means is, I know all of you are like, well, I'm in this for the long haul, I can handle a loss. Until you lose money and then you're like, I can't handle it, I can't do this. How do I know? Well, 16 years as a financial advisor, I watched this over and over. Everybody says they have an appetite for risk. Everybody says I'm in this for the long haul until the market pulls back 10%. They're like, I don't know. And then it goes 15 and they're like, I don't think I can do it. And then it goes 20 and they're like, get me out. I'm out. True or true? Yeah, you see, most people have forgotten about that because the market's been so good for so long. But a stop loss would be a really good way where you can take the human emotion out of it. You can just set it and forget it. Or if you're slightly more advanced or you follow some videos and learn how to do this, you could set trailing stops. Now that is a good idea. You could also set up some dollar cost averaging when the market starts going down and buy in systematically. Start slow, work into it, and then all of a sudden you're a trained freaking professional and you can brag to all your friends how you knew the top was there, you got out and you dollar cost averaged, and now you are sitting pretty. Now, one other thing I used to talk about, and I have not talked about this in a while because volatility's been all over the place. And you can track volatility by VXX. It's a volatility ETF that you could watch. When that sucker goes nuts, this gets more complicated. But once volatility kind of calms down, and volatility is usually pretty steady on the way up and pretty steady on the way down. But when we're in between, like we seem to be now, where we don't know if it's going up or it's going down, this can be difficult. But options. Okay, you've heard of them, right? Derivatives, you could buy some puts. Now, how puts go, there's calls and there's puts. So let me just kind of give you my way of thinking about it. A call. So if my phone rang right now, a call was coming in, I'm gonna pick up the phone, which means you would buy calls if you think the markets are gonna go up. And the same thing, I would put the phone down when I think the market's gonna go down. So if you were to buy puts on a particular stock that you think is going to go down, that could be advantageous. But again, I just want to throw caution to the wind. Only do that if you know, like, and understand how puts and calls work in derivatives. If you don't know, get somebody who does or start learning. Remember I mentioned earlier about GDP, gross domestic product? Well, it's teetering right now, and check this article out right here, because here is definitely one of the best indicators to know what direction the economy is going in. Well, last quarter came out and it was revised. Surprise, surprise. They always seem to revise these numbers when we're not paying attention. It was revised down from 1.6 to 1.3. That may not seem like a lot to you, but it's moving the wrong direction is all you need to know. The other thing I mentioned earlier is unemployment rates. Well, although it looks as if they're doing great until you look at this article right here, U.S. applications for unemployment benefits are holding steady, but continuing claims rise to a 3-year high. Coming to a theater near you is the new feature film called What Happens When You're Unemployed. Yeah, well, the movie's not out yet, so you're gonna have to sit back and watch the trailers and yeah. How many of you want to watch that movie? I'm probably the only one, but you know, when you're prepared for the movie and you're ready and you got your popcorn, you got your soda pops, you kind of sneak in some Kit Kats because they charge way too much for those darn things, and you're ready for the movie, but you're sitting there and you got to watch all the previews and you're like, when does this movie start? Well, that's kind of where we're at right now. Lots of previews before the feature film of what happens when you're unemployed starts. Anyway, let's keep going on. Let's talk about consumer confidence, because consumer confidence is essentially the driving force. It's how do you feel about everything? You feeling good? Maybe today you are. I mean, inauguration day. And maybe you're not feeling so good today. You're like, I can't believe he won. Well, he did. So here we go. And what that is going to mean is consumer confidence has to show everybody thinks things are good. And they do right now, until they don't. And right here, check this article out, all about, the Christmas time and how everybody was spending money, consumer confidence was up, they're just racking it up. But when you look at who's reporting that, like I mentioned earlier, MasterCard and Visa and Amex. I know that's a good indicator because people are using credit cards, but what also are people doing? Racking up unprecedented debt. I've covered this in multiple videos, how the credit card debt in this country is at all-time highs, showing consumer confidence can be up, but what does the debt mean? What happens when people lose their jobs and can't pay their debts? Yeah. And let's rapid fire through the rest of these. Gold and silver, we all know, are defensive plays where people put their wealth into precious metals because of the fear of instability, the unknown, the fear. That's what drives people to buy gold, and that drives the price up, which is happening right now. And the fifth one is rising inflation. I covered this earlier. It was going down, down we go as they raise interest rates up and up, but now they're raising interest rates, lowering interest rates down, and what is happening to inflation? Going up. Now, as per this report, it was saying that inflation was somewhere around 2.7, but I just covered this. Inflation was like 3.2, and they were celebrating, the markets were celebrating when it went down a little bit. It's like, wait, hold on a second. I covered this on WTF. They're celebrating that inflation is coming down, but inflation just went up a bunch. So how do we go up and then come down just a little and celebrate? I guess everybody just needs a reason to crack a beer and celebrate. Hey, maybe that's where we're at right now. So to wrap all this up, a little pretty bow tie, the economy is not doing well. And I know there's a lot of optimism around a new president coming in and a new administration that's just gonna clean house. But as I said before, this will take time. And if you can look back in time and you look at the Reagan administration, it was pretty similar. It could take 2 years before we even see a turnaround. So again, are you prepared? Is your house in order? Are you ready to take advantage of the opportunity, or are you prepared to lose your ass? It's gonna go one way or the other. Now the odds are you probably had some big wins in the last, who knows, decade, if you will, but at least the last couple of years. But you may have also had some big losses. The markets have been completely unstable. Now here's another interesting thing, and I found this just, recently. This is a report by Fred, And this is showing currency in circulation. I'll put it up on the board. Look at that. I mean, that's excessive money printing. And the only correlation I want to give you to this little chart, which looks like the best stock market gains you would see in your life, if that's what your chart looked like, but that is just money in circulation. Money that was printed out of thin air. Money that, when it was printed out of thin air, decreased the buying power of your money, which is inflationary, which is why it seems like prices go up, but it's not. It's just your money is buying less. I'm just trying to get you to see what's really going on out there. Is it worth it? Is it worth it for you to risk your retirement, your livelihood, your fortunes for big gains? Or should you take the conservative road and just play it safe and wait for the opportunity to come to you, just like Warren Buffett and all the big investors are doing right now? You see, all the institutions are preparing for the worst, but hoping for the best. You should do the same thing. So here's the final thing I'm going to say. You can have your cake and eat it too. You can. You can have your money in a safe place, growing with guaranteed returns, getting paid dividends on your money, also growing in a tax-free environment that's protected and private, and it provides an instant legacy should you ever graduate and go on to a better place. But at the same time that you're doing all of that, you could have that same money that's in that place, which is still earning uninterrupted compounding interest. You could have that money over in another investment. For example, if the markets go down, the S&P does fall 20, 30, 40, 50%. You could take money and invest from this place that's earning guaranteed returns into the market on the way down, but yet still make money twice. Or you could take money from this place and buy real estate when real estate prices go down. Or take money from this place and lend money out on real estate deals that are really conservative in a first lien positions. You see, you can have both, and you can make money twice on the same dollar. If you really love the sound of that, well, at the very end, I'm going to put up a video that shows you exactly how to do that. But with that being said, let's just go back and talk about the very fundamental reason I wanted to do this video. The things that are happening, the concentration in the markets, all the signs are pointing to one place, and that is not good if you just sit back and lollygag and just think that the markets are going to continue to go up, up, and up because, well, Donald Trump's going to take it to the moon. You're wrong. I'm just going to call it out. You are wrong. In the short run. In the long run, great. The problem I see is most people will not make it to that point because they will get scared. Fear will creep in. They will then start thinking, oh my God, I can't lose anymore, and they will sell. And you know who's going to be buying? Because when there's someone selling, there's always someone buying. You do understand that? The people who are ready. The people like Warren Buffett who have gotten prepared and are sitting on massive stockpiles of cash and T-bills, they are ready to pounce when you're ready to sell. The question is, are you selling now or are you selling when it's too late? That's what I wanted to think about. My name is Chris Naugle. This has been another episode of What Now? What's next for 2025? Hey, if you like this video, check this one out right here. It shows you how to make money twice on the same dollar and earn uninterrupted compounding interest. See you on the next.